Okay, in this video, I'm going to take a very quick look at moving averages. Moving averages themselves are one of the most common indicators, and this is a secondary indicator. Some people use them as a primary indicator, but there's about a billion ways to use moving averages. And this scenario, I'm going to talk about them as a secondary indicator. So the first thing that you need to know is that moving averages come in a lot of different flavors. One thing that causes a lot of argument is simple, exponential, smooth, linear, or weighted. Smooth and linear or weighted you hardly ever see. Exponential and simple are slightly different in the fact that a moving average is, in this case, 200 candlesticks, the average price at the close of each candle. It'll plot this as a line. If I were to do it exponential, it gives it a little bit more weight towards the last few candles. It reacts a little quicker. So I'll go ahead and put a 200 exponential moving average, and I'll make it dashed just so you can see there is a difference. It's not a massive difference. You got to realize this is 200 days worth of indication. So I tend to use the SMAs. I don't get too hung up on it as to the difference. So one of the ways that people use these moving averages, and 50, 100, and 200 are by far the most common, is determine the trend. But they also use it as a filter. So in this case, we have a nice hammer here on the dollar Canadian dollar. You could make an argument for, well, let's say 125 is holding as support, and that is a valid buy signal. However, people who follow trend trading will look at the 200-day exponential moving average, which is a year's worth of trading, at least from the stock market perspective, and that's what it carries over from. And it is decidedly to the downside. So they would not take this buying opportunity. They would expect this market more than likely to rally short term and then roll over again. Alternately, if this candlestick was to break below, that's a sell signal, plus it's with the 200-day exponential moving average. Now, you can see that at one point it was offering dynamic support and resistance, and then we sliced through it. We came back to test it and broke down, and that's quite common. Let me go ahead and insert two other moving averages just so you can see other examples. And in this case, I'll do a 50, and I'll do that in red because it's our faster one. And you can see it reacts much quicker. It's the average price of the last 50, and it does itself have an influence on the market. Let's go ahead and insert what would be the 6-month moving average, which is 100. Let's see here, 100. Let me go ahead and fix this because that is exponential. I want them all the same. Okay. You can see that 100 has a little bit of a reactive effect as well. So the way to look at this is quarter, 6-month, yearly. And that gives you an idea of how things are going. When you have all of them moving in the same direction, you have a very strong trend. At that point, most traders will completely ignore buy signals and only sell. What I find interesting, though, is you are underneath all three of these major moving averages. So if you get a bounce, you could get a lot of choppiness and sideways action. You can see that sometimes the moving averages are all twisted, and that's a sign that a lot of people will either go to a range-bound trading system, perhaps like a stochastic oscillator type of thing, or they'll just avoid it altogether. They want to see these nice trends. They do, like I said, cause a reaction because enough people pay attention to them. This was support, the 200-day, got broken, offered resistance, very much like a trend line. So you can think of it in a way as a moving trend line. In this case, this is a buy signal from a nice area. Could it work out? Yes, of course it could. But I think a lot of longer-term traders are going to be looking for a rally and then a failure. And again, of course, a breakdown below here would be very negative. So that's one way to use moving averages. There are systems, crossover systems and the like, that use moving averages. I will get into those later, but this is a very basic 30,000 feet overview of how moving averages are used as a secondary indicator, as a filter, or in this case, you had broken down, let's just go ahead and use the 200. You had broken down decidedly below there. You are now underneath it. That's negative. We have failed there again. Now it's offering resistance. And then if you get a signal, a breaking below that hammer, for example, or something to that effect, then it just gives you one more reason to be involved to the downside.